So did you write the notes? Mulipata? You got the notes? Okay. So we are not going to waste much time. If you got the notes and you got the notes, let's save time. Serious in the notes. Those service costs, interest components. And there is nothing serious in the notes. So what we do, let's just go to question straight, because I'm not planning to do one question or two. So when we do the first, then the beauty part of it, we have covered some part of this topic in some other topics, like when we were doing banking, when we were doing, I don't know which topic the other day here, there was that element. Cash flow, I think about what, but when we were doing banking, there was the element of the actuarial. So let's just go to a question direct. Open for me, December 2017. Let me start from there. December 2017. Which question? December 2017, question number 2. Go to page 63. Page number 63. Page number 63. Page number 63. Question 2C, sure. So let's read. Let's read. It says, the following information was extracted from the books of Comfort Retirement Benefit Scheme for the year ended 31st of October 2016 and 2017. So we have discount rates. So discount rate is the interest which is charged on the outstanding obligations. So that discount rate, right, the interest is the interest rate. That obligation is the interest rate. Then we have expected rate of return. So that is what you will get on your plan assets. Then average remaining service life. So the period the employee is expected to continue being in the scheme. Fair value of the plan assets. Present value of obligation, current service cost, benefits paid, contributions to the scheme. Then we have past service costs. Additional information, as at 1st of November 2015, the present value of plan obligation and the fair value of the plan asset were both shillings 100 million. Assume all transactions occurred at the year end. Required for each of the years 2016 and 2017, determine from 1, the actuarial gains or losses, the net pension costs to be charged in the income statement, then balances to be reflected in the statement of financial position. So, you know, when you are contributing in the scheme, the money you contribute, that is your investment. So the investment, you'll be advised by the actuary. The actuary will advise you that whatever you have invested at the end of this year, you will expect that the scheme will have grown to this much. And if you don't pay your obligations also we will charge you this much. Because even if you save with a bank, at the end of the day, you have obligation like ledger fee and the rest. So you check when they ask you to calculate the actuarial gain, what did the actuary, actuary are the people who does the evaluation of the schemes. How much did the actuary recommend in the scheme? What was the actual outcome for both plan asset and plan obligation? So when they tell you to calculate the actuarial gains and losses, check both plan asset and plan what? Obligation. So plan is the scheme itself. So let's start. Let's start with actuarial gain or losses. Actuarial gain, stop loss on plan obligation. Plan obligation. So plan obligation, you will have those 2 years, 2016, 2017. Shillings are in millions. Like that. So you start by saying present value of plan obligation brought down. Present value of plan obligation brought down. So you check when we started the year 2016. So don't go to 2017. We start with the 16. When we started 2016, how much was, liabilities are measured in terms of present value because they are expected to be paid in future. So how much was the outstanding obligation in 2016? That one you will be given was how much? Check additional information number 1. What did they say? As at this, the present value of plan obligation and fair value of plan assets were both how much? 100 million. First of all, 2015 is the opening of 2016. So this is 100. Then there is always a warning that if you don't settle the obligation, you will be charged what? Interest. So interest charge. They are charging interest at what rate? 10%. So no, they are charging like this. They are charging 10% year 1, year 2 they are charging 8. So 10% of 100, that is how much? 10. Then you will also incur something in the scheme called current service what? Costs. So are you seeing current service costs? So how much is the current service cost? Current service costs. So current service costs is how much? 8. So that one will be part of your obligation. If there is past service costs, just in case, past service costs also you charge in the current year. Past, you incur in relation to the services which had already been provided in the previous years. So past service costs, if you get into the question, also you add it, just add it to the current year. Then when you are paid benefits, benefits will reduce both your obligations because the assessment of obligation is based on what you have invested. So when they pay you benefits, then benefits will reduce both obligation, will reduce here, and then again will reduce the assets. So you come here and say, benefits paid. How much worth of benefits were paid? Benefits paid 15. Yes. So the actuarial assumption, it is called actuarial assumption. for actuarial assumption is this much. So how much did the actuary anticipate? Someone is telling me there was past service cost. Oh yes. There is past service cost. Sure. Thank you. So past service cost, it was there. Past service cost from your notes, you incur the current year for work that had been done in the previous years, but that expense will be captured. You don't go and adjust the previous financial years. So that is 4. So actuarial assumption is what they actually anticipated in the scheme. How much were they expecting to get to be in the scheme at the end? That is 107. Then skip 2 lines. 1, 2. Then you say present value of plan obligation carried down. How much is the closing value? Present value of plan obligation, 1st November 2016 is how much? 100. So we anticipated that the actuary, from their recommendations and projections, they expected 107. The actual outcome in the scheme, which is the end of 2016, we have 100. So your balancing figure where you are skipped here, your balancing figure is called either actuarial gain, it might be a gain, or it might be what? Loss. So you tell us, we lost, we gained. The assumption, which was the projection, was saying 107. The actual outcome in the scheme, 100. So we lost, we gained. I can see people also talking online. We gained. Online, what on some again? We gained or we lost? We lost gain. We gained because this is an obligation. If you anticipate an obligation of 107, ama ukienda kasle kulipia mtihani, ukasikia mtihani ni 107, ukabeba 107 ukafika kwa counter, akwambia hapana, yako unafaa ulipe 100. Unaanguka chini. Unamwambia you serious? Ndio. So this one is again we assign. So the gain should reduce the obligation. So decrease in obligation is again. So that is again. Then the closing figure for 2016 becomes the opening in 2017. So 2017, also you talk of 100. Then they want to charge us interest. So the interest charge is 8% for 2017. No, it's 8. 8. What is the current service cost? Current service cost, I'm told we are expected to incur 10. Benefits they have paid 12. So as I got you a projected. Then here there is no past service cost. So the actuarial assumption is how much? The actuarial assumption comes to 106. So this is 106. How much is the actual outcome in the scheme? 125. We gained, we lost. We have lost because the obligation, the liability has gone up. So we have lost by how much? We have lost by 19. So that is actuarial gain loss on plan obligation. You do the same for plan assets. You do the same for plan assets. Do the same for plan assets. So actuarial gain, stock loss on plan assets. So have here 2016, 2017. Shillings are in millions. Shillings are in millions. So for plan obligations, plan assets, so for plan assets, again, we start. So assets are not measured in present value. You measure them in what? Fair value. So fair value of plan assets, at the beginning. So brought down. How much? They were both 100. You know, in note number 1, they said at the start, they were both standing at 100. But of course, when you invest, you expect what? Returns. You know? So expected returns. What percentages? 12, 10%. So 12% of 100, 12. That is 12. Then the contributions you make to the scheme, contributions will increase your investment. So contributions, we have contributions. Yes, contributions to the scheme. That is 9. So top up the contributions. Then benefits, I told you, you reduce both obligation and the assets. So when you are paid benefits, reduce this. So benefits paid is how much? 15. So that is 15. You subtract. So the actuarial assumption is how much? Actuarial assumption 106. 106. Skip those 2 lines. What I call to skip because now you know the balancing figure will either be actuarial gain or actuarial what? Loss. So what is the balance carried down? So fair value of plan assets. Carried down. Carried down, they are giving us how much? 96. So closing is 96. We lost, we gain. We lost, we gain. We lost because this is an asset. So when asset goes down, it's the opposite of liability. We lost how much? 10. Sure. Then this one becomes the opening. So this is 96. So expected return will be up to 9.6.
Yes.
Contributions 11. Benefits paid. Actuarial assumption. Actual outcome. Gain loss of. So now on the liabilities, which is the obligation, here we gain, we lost. In the same years, we lost, we gain. So you compress, you get the aggregate. So you come here and say net actuarial gain stock loss. So you get the net position. So 2016, 2017. So in 2017, you say actuarial gain stock loss, actuarial gain stock loss, then actuarial gain stock loss on plan obligation, plan obligation, then actuarial gain stock loss on plan what? Assets. So in 2016, we gained how much? 7. Then here we lost 10. For obligations, we lost 19. We lost 19. Then we gained how much? 5.4. So the net will be a loss in both cases. So here there's a loss of 3. Then there is a loss of 13.6. We have fully answered Roman 1. You get 2 marks. Who is this? Can someone please resend PDF your question? So you can repost the past paper for someone. Roman 1, that is gone. Let's go to Roman 2. But they are easy to find out. Roman 2, the net pension cost to be charged in the income statement. Pension costs. So let's go to Roman 2 and pick up income statement of profit and loss extract. P&L extract, that is what we want. So P&L extract. So extract means just give us the profit and income which you are capable of seeing. So right here 2016, right here 2017. Shillings are in millions. Like that. So expenses, I'm only seeing expenses here. One of the expenses is called current what? Current service costs. So give me the current service cost. You just pick the expenses and liabilities which you are capable of seeing. So current service costs, those who have joined late, you just proceed from where you're getting us, then we are going to do another question. So you'll still get the concept. So current service cost, how much? 8 and 10. Then interest, you will also be charged interest. You will be charged interest. How much interest did they charge in 2016? 2016 was 10, and the other one 8. You have the figures. Then none of your expected returns. Expected returns is treated as income, but these are what? Expenses. So when you bring here the expected returns, so expected returns will reduce the expenses. So you reduce this by 12, you reduce this by 9.6. Because this is an income and all these are what? Expenses. So what do you get? The example. So what do you get in each case? Oh, there was also post. So post or fast, not post. Fast service what? Cost. You have to capture it in the current year. How much was this? Let me measure it now. It was 4. It's also an expense to be incurred in this current financial period. So can you get for us the net expense to be charged in the P&L? How much for year 1? 10. And the other year? How much? 8.4. Then other comprehensive income. Actuarial gain or loss is not recognized as part of normal business trading activity. So gain or loss on actuarial, you consider as part of other comprehensive. We got losses in both cases. The one we have just calculated net. So you say here, net actuarial. Actually, all of them were losses. Net actuarial gain, stroke loss. In each case, we lost. Here we lost 3. Here we lost 13.6. Therefore, the total is what you capture. I hope you are following keenly, so that when we go to the second question, you'll be safe. Let's go to the next, Roman 3. Balances to be reflected in the statement of financial position. Balances to be extracted is to be reflected in the statement of financial position. So, statement of financial position. Extracts. They're just requesting for the balances. You know, so far you should know where the earth is headed. Ukiangalia hiyo swali na share based, because all of them to me is share based, and this one at least one, all of them. Which one looks better? Share based. See this one? Because umeingia late, umeingia saa hii. Umeingia saa hii unaona ni ngumu. Itakuwa rahisi, wacha tufanye swali ya pili. Those are the effects of coming late. So we bring here present value of plan what? The asset will allow obligation and assets. So plan obligation, but remember to capture the closing balances. Balance sheet, you capture the closing balances. Lea na kuweza hii share base nifanye siku gani? Wadani. Hadi topic gani? Present value of plan obligation at the end is how much? 100 and 125. Fair value of plan assets. Plan assets, of course, you pick current down. How much? 96 and 110. So which one is more than the other one? Obligations are more than the assets. So use the assets to reduce the obligations. So net pension liability, it remains to be a liability. So net pension liability. See, this is the easiest. Other ya mwisho. See kama share based kuna story mingi. 3 living, 2 are undecided. How much is this? 4. And this one? 25. Hata Joshua huyu mwenye anakuja kasikia akisema hii ni good. Between this topic and shadows, which one is that? So let's go to another question. By the time unafanya ya pili, the learning curve itakuwa juu. Beatrice, what are you saying? Kindly explain why we are subtracting net actuarial gains or loss. Which one? I think you are talking about this. So they were losses, all of them. This one is what? The E10 and 8.4. What are they? Are they expenses or income? Which one? They remain as expenses. And this one's also losses. Then there was no need of subtracting this. Let them remain positive. Because using the expense, I get a loss. So the loss and expenses is one. Because here the expenses were more than the gains. So the net figure, the 10 and the 8.4, remained as what? As expenses. Then these ones were losses. So the losses we just top up the expenses. So I think I think that's what you are talking about. So they just remain as positive. And by the way, for extra, still as a word provided the option as those figures is enough. As you rectify that, let me check another question. Let's meet in 2019. Let me just check which 2019. I know 2019 for Afra. Capital reduction. Unakumbuka capital reduction? Yeah. Yeah? Page 6. Page 46. Employee benefits, yes. Yes, please, let's meet in page 46. The pension surplus, that one I'll explain later. Surplus, that's problem. Let's check that from Antu. Wake up on May 2019. Go to page 47. Page number 47. So page, that is May. So May 2019. Question number? The question? 3. 3 Roman 2. Let's check. That is page 47. So let us read. It says, W Limited, a public limited company, operates a defined benefit pension plan for its employees. The present value of the future benefit obligation as at 1st January 2018 was 38 million, and the fair value of the plan asset as at the same date was 2860. Further information relating to the pension plan for the year ended 31st December 2018 was as follows. So current service cost was that benefits paid to former employees, contributions paid in the plan, present value of benefits obligation 2018, fair value as at 31st December. Additional information, interest cost, gross yield on blue chip corporate bonds is at 5%. On 1st January 2018, the pension plan was amended to provide enhanced benefit with effect from that date. The present value of the enhanced benefit was calculated by actuaries at how much? 110. The required notes to the statement of comprehensive income and the statement of financial position to reflect the financial effects of the defined benefit. So, the computation do that donation. So, let's start with actuarial gain or loss on plan. Actuarial, these are the notes. Actuarial gain, stock loss on plan what? Obligation. On plan obligation. So if you came late, you're still safe now. So this one is 1 year. Sure. So it's just 1 year, 2018. So shillings are in millions. So for obligations, how much was the opening as 1st January? The value of the obligation at the start. So present value of plan obligation brought down. When we started, our obligation in the scheme was really 3080. Yes, it was 3080. However, what I was saying 3080. It is 3080, the example. There was enhanced, something was enhanced. Bullion. Enhancement can be done both sides, so it depends with what was enhanced. If they say, not true. The plan was amended to provide enhanced benefits with effect from that date. The present value of the enhanced benefits was calculated to be how much? 110. They wanted to enhance the benefits employees would get. So the present value they have discounted at 110. So enhancement, you might not know whether to top it up on the obligations or on the assets, but this one you top up on obligation. Why? They have mentioned the word present what? Value. Obligation is settled in the future. So obligations are measured in present value. But if they say for assets they talk of fair value. So if they say the fair value of enhanced benefits, then you top it up to the what? Your assets. So top up it here. Up. 110. So that plus that will be how much? What? At 190. Then always there is interest. So interest charge. Interest charge. There was something they mentioned in note number 1. Interest costs, gross yield on blue chip corporate, whatever is 5%. So if they give you only one rate, like in this question, it's just one rate, then the rate applies both to obligations and what? Assets. So you will take 5% of that value. 5% of that value. So they will increase the obligation if you fail to pay. How much is that? 159.5. Then current service costs to maintain the scheme. Current service costs. Actually, apart from past service costs, you bring the balance brought down, the interest will be charged, service cost, then you subtract the benefits. Full stop. So current service cost is how much? 20. That will increase your obligation. Then when you are paid benefits, you have to net off. So benefits paid, they were paid benefits worth how much? 240. So what you need to know and appreciate, when you have one interest rate, actually that's how it should be. Unapata interest on a kuchaji higher than the expected return. But ideally, interest should be the same for both. So this one is the actuarial assumption. Actuarial assumption. Actuarial assumption. How much is that? 3316.5. Then your balancing figure. So because it's 1 year, we don't know how many actuarial gain or loss. So let's leave it there. Present value of plan obligation. Plan obligation carried down. How much? 3360. Sure. In December. So Sylvia, is this actuarial gain or loss? Sylvia, we know we have 3 Sylvias in this class. So, is this a gain or loss according to you? We have lost, we have gained. That's a loss because the obligation has gone up. Yes. So actuarial loss. So you remember is so actuarial loss, the BF balancing figure there. How much? Isn't it to how much is this? 43.5. We lost. Mohammed, why are you saying we gain? Obligation ikienda juu unaweza kuwa umegain. Then let's do that same for the assets. Let's do the same for the assets. So actuarial gain from loss on plan assets. So shillings are in millions. Shillings are in millions. So assets we measure in terms of what? Fair value. Or plan assets brought down. So you said they have set the notes. So easily to those are the notes. So fair value of the plan assets brought down. How much was it? 2860. It was 2860. Then we expect returns. So expected returns. Expected returns at what rate? 5%. So 5% of that will give you how much? What? 143. Flat. Okay. Then we top up with what? Contribution. When you contribute, contributions, how much? 250, 259. Then we net out what? Benefits. So benefits paid. Benefits paid is how much? 240, 242. So the actuarial assumption $30, 20. So I'm lacking a space. So keep one line down there. Can you check the fair value? Fair value of the plan assets at the end. At the end, the plan assets is how much? The plan assets is 3113. Sure. 3113. So we gained, we lost. Watch out, Mohammed has said. Mohammed, we lost, we gained. Barbara has already said we gained. Sure, because the asset has gone up. So we have gained by how much? Huh? We gained with how much? 93. So we gained 93. Have that one as your balancing figure. Have that one as your balancing figure. Then down there you say, gain stock loss. And hakuna haja to gain stock loss. We can be able to say on the liabilities we lost. We lost 43. On the side of assets we gained 93. The net will be again, yes. So net actuarial gain, net actuarial gain will be 93 minus what? 43.5. You get here, you lost the other side. So you get the net position, which comes to 49.5. Also, it's recommended when you have one interest rate cutting across both obligation and liabilities, you just need to get the net interest position. So net interest, it is going to be net interest income or expense. We were charged 159.5. Then we got returns on the same rate. We got return of 143. So the net will be net interest expense. Because we were charged 159, we gained 143. So reduce, take this minus this. You remain with interest of 159.5 minus 143, giving us how much? 16.5. Good. Now let's have the extract of P&L. Let us give them extract of profit and loss. So P&L, I want to delete this one here. So P&L extract. Wanaweza leta swali kwa at least kizungu hapo vitu vingine, lakini ukiona ni kitu unajua, lakini sasa unaona ni kama kuna vile ameweka, si ukweli. Ni ukweli. Unaona tu require that you what wewe tengeneza tu hizo vitu unajua tunatengenezana. Gain, loss, actuarial, then you will find kumbe hiyo ndio ilikuwa swali. Si wewe fanya kitu alafu ukiuliza mwenzako after exam au muulize mwalimu after exam. Ukiambiwa unasema exactly that is what I did. Na uko unajua. So wewe urusha tu maneno. So P&L extract. So shillings are in millions. Shillings are in millions. So we bring what? Expenses first. I like starting with current service cost for reasons which I don't know. So current service cost, how much? To service the scheme? 209. Then interest expense. So interest expense, we have gotten the net of 16.5. So don't bring the expected returns. We have already compressed. Yes. So this is total expense of how much? 2.25. Then other comprehensive. This one goes to P&L direct. These ones are just considered. Actuarial is considered others. So other comprehensive, we have actuarial gain of how much? 49.5. So actuarial gain. This one was Net expense or income? Expense. So reduce. Bring 49.5 here to reduce the expense. So net pension cost is still remaining an expense. Net pension cost will remain how much? Net pension cost 166. 176. Give them the balance sheet. Give them the balance sheet. SFP extract. SFP extract. So SFP extract, you give us the fair value of plan. The other assets are in another obligation. Present value of plan obligation. Pick the closing figures. Carry down. Carry down obligation is 3360. Then fair value of plan assets. Plan assets carried down is how much? 31? 13. So assets are less. So net pension liability is how much? 2. Check for me, November 2020. Question 5. Page 35. Question 5B. What are you? Do we net gain and expenses? We do. That's what we have done. We have taken the expenses, then we have net the gain to back in 176. So check for me November 2020 question 5B, page 35. So read that question keenly. Go through the question. So November 2020. Question number 5. So the question says, and I read, on 1st of January 2019, Camille Limited commenced a defined benefit pension plan for the employees. Under the pension plan, Camille Limited has an obligation to provide staff with agreed post-employment benefits. Camille Limited carries the actuarial and investment risk associated with the pension scheme. The following information has been compiled for the financial year ended that. So, interest income on plan assets. Interest income on plan assets. So, they have calculated for us. It's the expected return. So, they have calculated what is good for them. That's a good gesture. Huh? The question might be good ahead. Employer contributions to the plan. No problem. Current service cost, interest on plan, liability. They have also calculated. No problem. Fair value at the end, we can also be able to say. Present value of obligation on 31st December. Oh, that is for no problem. Camille Limited's accountant was not sure which accounting standard to apply when accounting for the pension scheme. The only adjustment made to account for the scheme was to expense the company's contribution of 55 for the financial year 2019 in the statement of profit or loss and other comprehensive income, and to credit the cash account. Ile contribution alifanya ndio ali-expense na credit cash book, full stop. Like story required. Na ajui ni standard gani. Evaluate the treatment of Camille Limited's accountant as given the above issue. Offer any correction, if any, where, if any. If and any if and where necessary, use journal what? Entries. Ati offer any correction. Sasa ukishikwa, what are you offering? Una confused zaidi. So here, how many marks? 10. Hebu tuongee kidogo. Let's talk a bit. Then we offer them some solution. So andika hapo, we can write something small. The applicable standard. So let's say standard ni gani? Naweza kuandikia kidogo. Useme the applicable standard is IS 19. The applicable standard is IS 19. The applicable standard is IS 19 in bracket employee benefits, close the bracket. Employee benefits, close bracket. Full stop. Continuation. Camille Limited pension plan. Camille Limited pension plan is a defined benefit plan. Is a defined benefit plan. A defined benefit plan, since the company has an obligation. Since the company has an obligation to provide post-employment benefit plans. To provide post-employment benefit plans. Full stop. Another hyphen. The accountant has accounted for the contributions for the contributions incorrectly, by simply recognizing employer's contribution. Employer's contribution in the statement of financial position. Employer's contribution in the statement of financial position in bracket cash book. In the statement of financial position in bracket cash book. And as an expense. And as an expense. And as an expense in the statement of profit stock loss. Negative P&L. In the statement of profit stock loss. Full stop. That should not be the treatment. So down there you say IAS 19 requires, IAS 19 requires that a defined benefit liability, defined benefit liability should be recognized in the statement of financial position. Should be recognized in the statement of financial position. Statement recognized in the statement of financial position and its present value, not and at its present value. In the statement of financial position at its present value, less the fair value, less the fair value of plan assets. Less the fair value of plan assets at the end of the reporting period. At the end of the reporting period. Full stop. Another hyphen. Leo tunataka kuchambua huyo accountant mpaka shike adabu. Another hyphen. The accountant. Accountant is a subject matter here. The accountant has also ignored. The accountant has also ignored the current service costs. The accountant has also ignored the current service costs and interest charge. And the interest charge in the P&L. In the P&L. So here to the contribution of 55 credit aliweka huko kama expense. You need to capture the expenses like the interest charges, the current service cost, check the net actuarial. Hapo chini, Rika. In addition, comma, the accountant should have recognized. In addition, the accountant should have recognized net actuarial gain stock loss. The accountant should have recognized net actuarial gain stock loss in other comprehensive income. In other comprehensive income. Full stop. In conclusion, I will see you say, therefore, the accounting treatment should be as follows. So you don't need to know those exact words. Where angalia tu kitu amefanya yenyewe. It's not correct. Alichukua the contribution akaweka kama nini? Expense. That is not the case. You need to check current service cost. For the P&L, we need what? Current service cost. We need to charge what? Interest. Then apart from a current service cost and interest, also you need down there another comprehensive income to recognize claims to what? the net actuarial gain stock loss. Then in the balance sheet, here the credit cash book with the 55. So you need to check the present value of the plan obligation at the end, and also the fair value of the plan assets. So the accountant had ignored. So even if you could mention that only, that's enough. To just say the accountant, Apple, kuna issue. You know, examiner said accountant did not know which standard to apply. So usikuja hapo unless you are very sure. Usikuja hapo kusema IS number 19. What if usahau andike IFRS 19? So you unageneralize aje? Lazima ucheze na clear examiner. Unacheza hapo katikati. Because they want you to say what the accounting standard wants. Unasema according to accounting standards on employee benefits, the accountants should have recognized the following. Una steps. Then similarly, in the statement of financial position, then they should have accounted for it as follows. So just follow the normal procedure. Let's follow the normal procedure. So we get actuarial gain loss on plan obligation, actuarial gain loss on plan assets. We get the net position. Then I'm not coming up with the balance sheet of P&L. Why? They have said, some of you really if. Yeah? If and where necessary, use journals. You know, once you pass journals, because we find a profit and balance sheet, because journals they really debit this and credit this, debit this and credit. So I'm not going to use to show the P&L and balance sheet. Instead, we are going to pass what? Journals. So let's start with actuarial gain or loss. Next week, if and where necessary. So actuarial gain stock loss on plan and obligation, but I think it will na faraja assets. So actuarial gain stock loss on plan obligations. So 1 year. So we have here shillings. We have their shillings. Were we given the present value of the plan obligation at the start? Present value of plan obligation. Wrote down. How many walianza skill? Yes. Should we answer? 1st January 2019. And we are preparing the books also 31st December 2019. So there was no opening balance. However, projectors are no money. They said interest. Interest on plan what? On plan liability will be how much? 18,000. The obligation. Then current service cost. Current service cost. It was year 1, so there was no opening. Current service cost is how much? 600. Then benefits paid. You go well. Hakuna. Ni sawa. Hata unalipwaje year 1. Benefits paid nothing. So actuarial assumption. Actuarial assumption is how much? 618. The actual outcome, present value of plan, present value of plan obligation, current down. How much? 620. We gained, we lost. we lost. The obligation went up. So actuarial loss is the DF. How much we lost? 2. We lost 2. Let's do the same for ukiona swali imekukalia kwa mjadala ya employee benefits. Wewe unafanya tu vitu kama hizi. Ukifikiria unapoteza wakati. Wapi unapita? Ana hiyo swali ungewacha kuongea na once to straight. You will not miss something like 6 marks. Let's do for plan assets. Just when you are the one who came next, but based on what we have done, if you compare this with share-based, which one is more better? Sylvia, you have changed. So just as time goes by, you realize this is easy. This one is easier. Actuarial gain, stock loss. Let me hear from online. In online, you are going. I can see about 88 participants. So, online. Which one is better? Share-based or employee benefits from what you have seen? So online let us what time? Here, latecomers are saying share-based is better than this. Those who came earlier are saying this is better. So whatever I'm saying, employee benefits, stop there. Employee benefits is easy. So I just know it is easy. So get on plan assets. Ile wanataka kutwist na kizungu, share-based. Some are leaving, some are uncomfortable to stay. So, fair value of plan assets brought down. How much? Nothing. So it was the start. So there is interest income. Interest income, we were given 16,500. Then contributions. Contributions to the scheme is how much? Contributions, employer contribution to the plan, 550. Benefits paid were not there. So benefits could have reduced this. Nobody will pay you in year 1. So add 566. Sure. 566, 500. Compare with the closing. Compare with the closing, balance carried down. Balance carried down. How much is that? Yeah. What? 580. 580. We gained, we lost. We gained. We gained how much? So I'm sure you'll gain. How much is the gain? 13,500. 13,500. So get me the net actuarial gain. Before you start thinking of intergroup sales. So next, actuarial gain. We gained 13,500, then we lost how much? 2,000. So the net gain is 11,500. Allow me to also net the interest. So net interest is going to be interest income or interest expense. Here the interest is 16, 18. Expense, right? Yes. So net interest expense is going to be 18. We were charged 18, but we received how much? 16.5. Giving you how much? 15. Giving you 1,500. If and where necessary, use what? Journal entries. So hapo ningeenda nifanye P&L, lakini kama wataki hizo P&L. So come up with journal entries. I told you, any moment you are being told of journals, they are just requesting you to tell them which account is debit and which one to debit. So the most crucial ones for the journals, this one, interest, also the actuarial gain, that one should be passed. So this is income expense. Another expense is this one here, copy current service cost. These two may combine LNG. So this one here, current service cost, 600. Those are what I'm going to pass in the journals, the income and the expenses. So we can start with which one do you want me to start with? Which one? We start with current service cost. So let's start with current service cost. Current service cost is an expense. How do we record expenses in the journals? Do we debit expenses or we credit? We debit. That is true. So you come here and say, Journal 1, profit and loss account. You debit the profit account. Profit or loss account, I'll debit. So debit to P&L is an expense. So debit your P&L with 600. Then you increase pension liability. So pension liability, you increase it with 600. That one increases the liability. So whatever increases liability, you credit. Because we normally talk with meet tax narrations. So tax narrations were naked to recognize the pension, the current service cost. By the way, fair narration up to recognize the current service, costs. To recognize the current service costs. Next, let's go to number 2. Number 2, let me bring the gain. So gain will reduce your liabilities. So the gain will reduce the liabilities. So you debit pension liability. To reduce liability, you debit the pension liability account. So pension liability. This one will reduce the liability with 11.5. Then you credit the profits, the profit account, profit stock loss as income. That is an income. Though, delete other comprehensive income. Other comprehensive income. It does not go to P&L. So OCI, other comprehensive income, with 11.5. So you can say in your narrations to record or to recognize, which one makes you happy? Recognize the net actuarial gain. Net actuarial gain. This one is an interest. This one will increase. It will increase the liability. So you will debit the P&L. Another goes to P&L. P&L interest, the interest expense 15. Then you credit pension liability account. Pension liability 15. Hiyo swali italetwa siku moja tena. Sidhani kama students walifanya vizuri. To recognize the pension, the net interest period, full stop. Full stop. Hivyo tu tumeisha. Ukitaka kuongeza kitu wewe unaongeza, unasema kindly advise the accountant to check the workings. Haya, so subtopic. At what time do you want me to finish the class? Acha online uongee kwanza. What time do you want us to stop? Hello. People are requesting 9. Let me 10. No, let me try latest 9:30. Sure. Latest by 9:30. So 9:30 and below. Evening unajua? Unajua sijui vile kunaendelea. Because mwalimu FM is around. Is waiting to come for evening and early morning. Sure. FM. Mwalimu LM watu wa early morning, this evening. Yeye pia ako around. Nataka watu wa early morning. So whoever will come first. So sijui watagawana aje. Ama mmoja atasimama hii side, sio? Hii side. Safari endelee. Mimi bora nimemaliza hapa. So right for me there. Ndio tumalize. Latest 9:30 tutakuwa tumalize. Overfunded and underfunded schemes. Are people at home complaining about your classes? You must know Are they complaining? I mean, kwa muda kidogo almost. Kidogo tu. He overfunded and underfunded. I don't think if they can bring it in this section. He would have that section. It's quite easy. But just for margin of safety. Basi tumalize. Yes. Tuandike. An overfunded scheme. We are writing. An overfunded scheme. An overfunded scheme is one in which the plan asset exceeds the plan liabilities. The plan asset exceeds the plan liabilities. Full stop. Continuation. It gives rise to an experience, to an experience surplus. Gives rise to an experience surplus in the scheme. and experience surplus in the scheme. Full stop. In this case, and anasema pastor na complain. In this case, the contributor stroke employer, takes a contribution holiday. Takes a contribution holiday before resuming to the standard contribution. Before resuming to the standard contribution. Full stop. During this period, comma, the amount to be recognized or to be charged, the amount to be charged to the P&L, should be calculated as follows. So you say charge to P&L is equals to normal contribution minus, because it's an overfunding. So overfunded means you have surplus. Now you stop. You take a contribution holiday. Stop. So remaining service life. So service life is the period the contributor is expected to remain in the scheme. But this brings the issue of NSSF into the picture. How many people are doing voluntary contribution to NSSF? Who does? Nobody. Who does voluntary contributions? Who is an employed? You are employed, but you are employed, but you do voluntary contribution. So when is complaining, your person is happy. So from next month, let's start with voluntary contributions. It is to your benefit. Ama, at how now? You know, you just tell the employer, though there is a limit, just tell the employer to top up instead of this one 200 split tier 1 tier 2. They can do voluntary from your pay, and it will of course reduce your pay as you are. So instead of remitting a lot of pay to KRA, so you tax plan. So those are measures of tax planning. So you tax plan by contributing more, and that is your pension. Okay. Wacha tuache hiyo. Wale wanasema kuna siku nilisema watu wasicontribute huko. Finally, sorry to maliza. 9:30 inakaribia. Naona watu wameleta story mingi. Haya, so if there is an overfunding, that is what happens. You take a contribution holiday, you want to go stop for some time. So during the time you are expected to stop, what you will be charged during that period, you calculate by taking normal. This one you will understand when we are doing that question. Underfunded scheme. Underfunded scheme. Kuna advice mzuri unapeana hapo basi sasa. A scheme is said to be underfunded. A scheme is said to be underfunded. A scheme is said to be underfunded when the fund assets are insufficient. The fund assets are insufficient to cover the fund liabilities. Are insufficient to cover the fund liabilities. Are insufficient to cover the fund liabilities. Full stop. It gives rise to an experience deficit. It gives rise to an experience deficit in the scheme. An experience deficit in the scheme. Full stop. Another hyphen. The employer stroke contributor. The employer stroke contributor will be required. The employer stroke contributor will be required to contribute over and above. To contribute over and above. Over and above the standard contribution. Over and above the standard contribution. Over and above the standard contribution until the deficiency is cleared. Until the deficiency is cleared. Full stop. During this period, Jen kidogo tu, I will repeat, and that opportunity. During this period, the amount to be charged during this period, the amount to be charged in the profit and loss, the amount to be charged in the profit and loss should be calculated as follows. Should be calculated as follows. So we say charge to P&L is equals to normal. You take normal contribution plus the deficit. If you are underfunded, you take the deficit, you divide by the remaining service life. Service life is the period that you will be expected to remain in that scheme. So Jen, I think paragraph 2. Paragraph 2, I said the employer stroke contributor will be required to contribute over and above the standard contribution, over and above the standard contribution until the deficiency is cleared. Full stop. Chana hiyo story hapo. Andika illustration. Illustration, you are the set bitangulini. Let me check if I have a question here. Let me see. Relax a bit. I check if I have a question, which I think I should be having, although I don't know where. You can relax a bit as I check the question, if I have in my email. So I'm not even going to print. I'm sharing online. So kila mtu afungue simu yake. Yote ya kuprint itafanya nitaki pika haraka. So I'll send the question. So open. I've added you more questions on what we have done in that handout. So I want us to do question 3. So you will do for me question 1, attempt question 1 on your own. Question 2, I'll tell you something about it. Your question which I want us to do, but I'm sending you the solution to question 2. Question 1, do on your own, is just what we have been doing. Question 4, also just do it on your own. There is nothing serious. So I want to do question 3. Let us work out question 3. Then the class will just end like that. Hiyo semester imetufanyia. Mkimaliza semester ya composition about a semester to remember. Let's go to question 3. Question 3 says, the actuarial valuation, everyone is there? Okay, the actuarial valuation of Treasury Silver Handshake Limited showed a deficiency of shillings 120 million as at 31st December 2009. Usually by the 2009, Handshake 2009. With the recommendation of actuary, the company should eliminate the deficiency with the 3 lump sum payments of shillings 40 million. 40 times 3, 120. Yes. In addition to the standard contribution of shillings 20 per year. The contribution will continue at shillings 20 thereafter. It is estimated that the average remaining life of the employees in the plan as at 31st December 2009 is how many years? 10 years. Required, 1, determine the charge to the income statement, and 2, the amount to be disclosed in the balance sheet as net pension liability or prepayment in each of the years. So, let's start. It's quite easy. They are having a deficit or a surplus. Deficit. So if you have the deficit in the scheme, so that is handout question 3. Handout question 3. So if you have a deficit, how do you rectify the scheme? So we have started a formula. So charge, which is required from 1, charge to P&L. You take whatever you have been contributing, normal contribution, which is the standard contribution. We add or we less the deficit. We add. Yes, so if you have the deficit, you add deficit, then you divide by the remaining number of what? Yes. So the normal contribution, they were contributing how much per year? What was the standard contribution? 20, sure. Yes, they were contributing 20. Every financial year, it was 20 million. The deficit is how much? They have a deficit of 120, but they can't clear once. So the deficit of 120, you will spread it over the remaining years of how many years? 10 years. Yes, 10 years. So it means the expense which that person should incur every year now will be how much? 32 million. But A is answered. Whether ni kitu tu unaweza angukia kwa mtihani ni rahisi, but unaweza angukia ushinde unaanzia wapi. That is easy. Then part B, the amount to be disclosed. The amount to be disclosed in the balance sheet as a net pension liability. Amount to be disclosed in the balance sheet as liability or prepayment. So that one, I want to delete here. For which year? They want for which year? Who's some of you require? For each year, which is how many years? 10. Okay. So for all those 10 years, so write for me here. This can take us 3 to 9. Another make a year 1 to 10. So write year 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So out of those 10 years, have the 10 years. Then you will say contributions, what they will be contributing. So annual contribution. Then of what you contribute, you will be charged. There is amount you will be charged in the profit account. Then what will remain will either be asset or what? Liability. So what you pay, there is that which will be charged as interest. So you deduct of your contribution, the deduct, what remains will be your asset or liability. So once you present that, we have answered the question. So let's start. What was the recommendation? Well, recommend that. What did they recommend? How will we be contributing to rectify it? On top of the normal, what will happen? I'm out of better time. Before required. You as you. One out of like a similar landscape, not out of the so what have they said? Above the normal, they will be contributing 40 million above the normal. For how many years? For 3 years. So for the first 3 years, they'll be contributing how much? 60, 60, 60. Sure. The 40 plus 20 for the next 3 years. Then after that, what will happen? They go back to the normal contribution. Sure. Of 20, 20, 20, 20, 20, 20, 20. I charge to be a net of 32. So 32, 32, 32. That one will be constant throughout the period. It will be spread over the remaining years. It will be spread over the remaining years. Then, of what they will contribute, because what the default before, they will be charged this amount throughout. So take 60 minus this. What remains will either be an asset or liability. So how much is remaining? 28, which is an asset or liability? An asset. Yes, because they have contributed 60, they have been deducted 32. So 28 remaining is due to them. That is okay. Year 2, another 28. But now 28 cumulative will be. So the asset will have gone up to 56. Another 60, 28, 28 plus 56, 84. So 84 asset. So mimi nimechoka. Wewe enda mpaka mwisho. Inafaa ikuwe nil. Once you rectify after their recommendation, you should have nil position. So can you proceed and you get nil? So unaweza andika ya 10 nil alafu ujaze hizo zingine. Imekuja nil. So that is nil. Nil here came to 72, but still asset. 60. 96. Isha. Let's go to the other question in number 2. So 3B. 3B, nobody's having a question here. Wananchi wamefanya nini? MM Limited is a defined benefit plan which has been operating for some years. The actuarial valuation as of 31st December 2009 showed that there is a surplus of 320. Alipa mingi mpaka kuna surplus. The actuary recommended that the surplus might be eliminated by MM taking a short contribution break of how many years? 3 years. So when you're taking a break, you don't pay those years. Nil at all. You don't pay. And start paying annual contributions, that is in the 4th year, of how much? 40 million for 7 years. The estimated average is 10. The standard contribution is 60. Ignore interest charge in SAR. We will ignore. The amount to P&L, then the amount to be disclosed. The same thing. So let's start. So charge to P&L. So let's calculate how much is. When you have surplus, we have less. So charge to P&L. So to P&L, we will take, what's the formula? Normal contribution minus the surplus over the remaining years. So normal they said was how much? 60. So the normal was 60 minus surplus was 320, remaining years 10. How much will we expense them every year? 28. So we expense them 28. Full stop. So me, I'm not coming up with another table. My table is this one. So you write something again like that. We are 1 to 10. So here I'm just changing to 28. So 28, 28, 28. 28, 28, 28, 28. What will I Yes. So we can start. They were told to take holiday, yeah? For how many years? So 3 years, 3 years. Then they go back, they start contributing how much? 40. So 40 for the 7 years. So 40, 40, 40, 40, 40. So the first year, 0, nothing, minus this, negative. That's an liability. 0 minus 28. Another liability, but it will go up to 56. Another one, 28. Liability will go to 84. Liability 40 minus 28, 12. But 12 is an asset. So the asset to reduce this, it will reduce it to still negative. Right? As proceed, it should be nil when you are done. So proceed and get nil. Nil. Full stop. So our last class, our last combined class will be next week on Sunday, and we'll be doing insurance. And anything I will may deem fit. So IFRS 4, insurance contracts. That will be our last combined class. Kila mtu anajua class yao na kitu wanafaa wafanye kwa class yao. So thank you so much for the time. Have a blessed weekend. As we thank you. Online, you can log out. I end the class. Thank you.